Hi there, Etoro. It is Tuesday, the 9th of May, and that means it's time to take a look at what moved the markets last week. I didn't do a video update last week, but I did put a post up on Etoro that described some of the events that had already happened. The majority of the focus last week would have been on the US in terms of the Fed's decision with regards to the interest rate, but there was no real surprise there, and it seems as though the rate that had been chosen was more or less already priced in. The other major focus that the market had last week would have been jobs and employment data out of the US, and there was quite a lot of that hit the market last week. For example, there was the JOLTS data, the ADP non-farm employment data on Wednesday. On Thursday, we got the initial jobless claims, and on Friday, we got the NFPs and the unemployment rate. Now, across those various measures, some of them showed weakness. So for example, JOLTS job openings came in quite a lot lower than expected. However, the unemployment rate was a lot lower than expected. This is showing us that the situation with regards to US employment is a bit of a mixed bag at the moment. It was uniformly strong before, but now is starting to deteriorate in terms of strength. We also got interesting data out of a few other major economies. For example, out of the EUR, we saw the interest rate decision, which was bang on as was expected. And we also got a smattering of PMI data from various countries, which tend to be leading indicators of economic strength, and the US coming in slightly weaker than expected for services. However, for the UK, the PMIs are actually quite a lot stronger than was expected, pointing to some unexpected strength in the economy down the line. There are several things that are grabbing the market's attention at the moment. For example, the regional banks saga in the US. Of course, interest rates and inflation continue to be prevalent themes. But one of the largest focus for the markets right now are most certainly earnings. And earnings to me are far more important than economic and political goings on, because no matter what happens in the world, I want to be invested in the best possible companies. Last week was a big week for my particular portfolio, so you can see that a number of companies reported earnings. Mercado Libre, Zillow, Shopify, Square, now Block, Volkswagen, and Warner Brothers Discovery. So let's take a quick look at the highlights from a few of those businesses. Mercado Libre happens to be one of my favorite companies, one of my strongest conviction companies. They're a company that has been compared to Amazon, so they're often called the Amazon of South and Central America. Although there are some key differences within their business. For example, they don't have that AWS component, but they have been investing heavily in this fintech component within their business, and it has been growing very, very fast. If we look at a few of the key messages from their quarterly earnings presentation from last week, you can see that their EBIT margin has been increasing year on year, so expanding margins, that's what we like to see. You'll also notice that the GMV, which is one raw measure of how well their e-commerce and retail business is doing, was growing at 43% year on year. The fulfillment component of their business has also been growing quite quickly. And finally, that fintech area that I mentioned before, the total payment volume, another raw measure of the success of that part of the business, grew 100% on an FX neutral basis for the 6th consecutive quarter. I've said this before in previous videos. This fintech component of Mercado Libre is similar to what Ant Group was to Alibaba when it still was a part of their company. Now, the stock didn't move very much on this news on the day following the earnings presentation. And I think in part investors are wary of investing in companies that are highly cyclical, and e-commerce businesses, retail businesses, payment businesses are quite cyclical. So if the world is facing a massive slowdown in the near-term future, then companies like this might be affected. But this is still a best-in-breed company, and if the stock price did drop significantly, I would definitely be adding more to my portfolio. For those that are interested in a few snapshot numbers from Mercado Libre, this company just keeps on winning. Look at this revenue growth. In 2017, $1.2 billion. By 2022, $10.5 billion. So a CAGR on revenue of 54%. Operating profits growing at an annual rate of 77%. Net profit, so pure profit, growing at 100% year on year. Another thing that might be worrying investors is that this company isn't priced super cheaply. It is priced for growth. The PE ratio in some instances, especially with hypergrowth companies, is a bit meaningless. The PEG ratio is something that has a bit more meaning because it compares the PE ratio to the growth in earnings rate. However, ideally you want this number to be below 1, and at the moment it is sitting at 2. So it is fair to say that Mercado Libre is priced at a premium right now, but it is a company that continues to fire on all cylinders. If there is some kind of global economic contraction, yes, it might affect them in the near term, but I'm not so worried about that. I'm looking at the return on this business over the next 5 to 10 years. Another company that I really like is Block, which used to be called Square. This is a fintech company that's grown rapidly, especially through the pandemic, which makes people a little bit wary of it because it was one of those fast growers. Through the pandemic, people wonder whether there is substance to this business, but there most certainly is, in my opinion. Block knocked their earnings report out of the park, so they beat on both earnings and revenue, and they raised guidance for the coming year. There are a lot of fantastic details which are summarized quite well by this author on Seeking Alpha. It's always important too that you look at the good, bad and ugly when it comes to any company. And the most prominent negative point when it comes to Block is that their operating income is still negative. They're still making an operating loss. However, this is one of those companies that does grow very rapidly. They do try to accumulate market share before turning the dials and becoming more profitable. And you can see, for example, on the chart on screen, that the operating income is moving in the right direction, and their operating income should turn positive in the near-term future. One of my portfolio companies that absolutely knocked it out of the park last week was Shopify. Shopify is a company whose stock price was growing very rapidly before the pandemic. It was, I think, expensive even before the pandemic. And then through the pandemic, when lots of brick and mortar companies turned to Shopify in order to become companies that could sell things online, their revenue went stratospheric, and so did the share price, and they were ridiculously expensive. But the price has crashed back down to earth. And they've had a few weak quarters whilst they reshuffle their business, refocus themselves, and deal with a bit of slack demand on account of a slowdown within the retail sphere in general. There are way too many points to talk through in a video like today. I could spend 30 minutes to an hour talking about Shopify alone. But if you look at a few of the numbers on screen, you can see that GMV increased 15%, total revenue up 25%, monthly recurring revenue, which is something that's very important to SaaS businesses overall, increased 10%. And something that investors will be following very closely is the operating income, which is still a loss for Shopify, but it's a loss that is trending towards profitability, much like Block is. Another point that investors have been laser focused on has been free cash flow, particularly in this type of operating environment. And you can see that they are positive now compared to a negative number of free cash flow for the first quarter of last year. Something else that I found very interesting is that they've sold their logistical assets to Flexport, which means that they can focus their business on what they do best, and also raises a good deal of cash in order to weather the storm and invest in the right places within the company. Taking a break from US companies and looking at the Volkswagen Group, the earnings report that they published was very good. Their revenue was up quite nicely year on year. Profitability took a bit of a hit because they'd hedged on the commodities that they buy, and that hedge went the wrong way for them, knocking their profitability. However, if we look at the outlook for 2023, as well as their plans for beyond that, I think that Volkswagen is a very, very cheap company, particularly when you look at the other assets that Volkswagen owns or is an investor in. Just as a very quick reminder, and I've spoken about this in detail in a previous video, VW isn't just Volkswagen, not just the VW vehicles, it also owns a number of other brands. And some of these brands are listed themselves, so Porsche listed fairly recently, very successfully. They also have a controlling stake in or a large investment in a number of other brands, some of which are showing a lot of promise. For example, Traton is doing very, very well at the moment. Jumping back across the pond and returning to the US, the final company that I wanted to talk about in the update today, Warner Bros. Discovery. On the surface of things, the earnings report was quite a mixed bag. Revenue was decent, profitability wasn't great. They took a very large hit from depreciation of some of their assets. And they continue to be a business that's very difficult to read. Now, as some of you may know, Discovery bought Warner Brothers, the Warner Brothers brand, and all of its assets from AT&T. As part of that, they inherited a mountain of debt, and also they found out much later a messier company than they had expected. The challenge for the people running this company are multifold. First of all, People are dropping cable and terrestrial TV systems very, very fast, so there's ad revenue that's declining very quickly there. Companies like this are trying to figure out very quickly how to replace that lost ad revenue in online streaming services, but they're not there just yet. At the same time, Discovery's got to absorb this behemoth that is Warner Brothers and bring it into its company and merge the two businesses the way that they operate. And that in itself is a very big task. It costs a lot of money and it takes time. And then there's this mountain of debt that they've inherited. So from the investor perspective, like myself, for example, there's a bit of a race going on. They've got some very good assets. Discovery has some very good technology. They need to merge all of these various assets under one umbrella. They need to address the challenges of a declining cable and terrestrial television audience. And then they need to generate enough cash to eat away at this enormous mountain of debt as they go along. I spent the past couple of years hoovering up all of the details about these businesses that I can. And although it's quite messy right now, I do think that Warner Brothers Discovery is going to come out the other side of this a very, very powerful player in this industry. If you go through the details of the earnings report, you will see hints of this in those details. For example, their direct-to-consumer offering, which includes things such as their streaming services, is growing very, very nicely. Despite the enormous reorganization of their business, it looks as though free cash flow growth is going in the right direction. And the amount of debt that the company is carrying, although it is still enormous, is being eroded very rapidly. I'm not going to say that there is no risk when it comes to Warner Brothers Discovery. I think that it's fairly obvious where the risk is right now. I still think that they are doing the right things. It's just a matter of waiting a couple of years before we start seeing the rewards from the hard work that they're doing right now. All right, so what is going on this week? Well, the reason I'm making this video on Tuesday and not Monday is it was a bank holiday here yesterday. But the most important piece of macroeconomic data will be coming out of the US tomorrow, and it'll be these CPI numbers, inflation numbers. The reason that the market will be so focused on inflation data is because whatever numbers we get out of that will determine what the Federal Reserve does next in terms of interest rates. Right now, the market expects the Federal Reserve to hold the current level of rates for a while, a few months or quarters, and then start bringing them back down again. However, if they're coming higher than expected, there might be another round of interest rate hikes. When trying to figure out what might happen next, I find it quite interesting to look back through historical data. And so on screen, we have the Federal Reserve's interest rate decisions going back to 1982. What's immediately obvious is that during certain periods in history, the interest rate has spiked very sharply, fairly quickly, and then suddenly drops off just about as quickly as it rose. Unfortunately, in many of these cases, the reason that the interest rate dropped very sharply from these peaks was because something broke in an economy. And so this is what is making investors very nervous right now. They're also looking back at history, and they've noticed that when the interest rate rises very sharply over a short period of time, something goes wrong. Quite often there is a large recession that follows that, and then rates drop very rapidly in order to stoke growth within the economy once again. So will that be the case once again? Nobody really knows. But let's park the doom and gloom bus to one side for a moment, and let's say that the US Federal Reserve somehow magically gets their soft landing, which I think is incredibly unlikely, but let's say that they do. When will interest rates come down again? Well, if we look at my inflation and interest rate tracker that I have built with the help of Google Sheets, you'll notice that at the moment, the interest rate and the inflation rate are more or less the same within the US. Historically speaking, the US Fed will hold the interest rate at a level that is higher than the inflation rate for a period of time until they see that inflation rate reaching their target rate, which at the moment they're saying is around 2%. So in the scenario where the US economy doesn't come crashing down, forcing the US Fed to cut rates rapidly, I think that we will likely see the interest rate sit roughly at the level that it is right now, at least for a few more quarters. And while macro might be the thing that the market is laser focused on this week, particularly the inflation data out of the US, we are still in the midst of earnings season, and a number of my portfolio companies will be reporting earnings. You can see several of these on screen at the moment. It's the 9th today. And we will get an interest rate decision out of the central bank in the UK on Thursday. All right, that's it for this week. I hope you found that useful, and I will speak to you soon. Goodbye.